Okay, everyone. So welcome back to another weekly watch list video. In this video, I'm going to go over everything you need to know for the coming week. We're also going to unpack so much that happened last week. All right. Before we do, hit the thumbs up. And if you are new, consider subscribing to the channel. So we're going to start here with the earnings for the week. As you can see right here, up on your screen right now, like I always say, if you're going to trade these and you're going to use options, the premiums are going to be elevated. So keep that in mind. It's always risky trading around earnings season. You never know what the guidance is going to be. Even if the report is very good for the previous quarter, investors are always looking out for the future. So that guidance is very important. Okay, now the economic calendar. It's very important that if you're trading, if you're swing trading, you're investing, you want to be aware of the economic calendar. Before I go over this coming week, I want to look back at last week. Last week on Tuesday is when Powell started to testify. He testified to the Senate on Tuesday and then on Wednesday to the House. All right, that's Tuesday and Wednesday. Those 2 days, we started to see the market go down. We started to see the market start to price in some higher rates going forward and keeping them there for much longer than I think investors were expecting. Now, the whole idea of them, cutting rates towards the end of this year has pretty much been totally taken off of the table at this point. And then on Thursday, we saw the jobless claims, which actually came in hotter or higher than estimated. Normally, this would make the market go up. The market went down. Now, a lot of that also had to do with the fact that the banks had a very tough time with SVB, okay, Silicon Valley Bank. That is basically when they started to tank. Their stock price dropped a huge amount, and they ended up eventually going out of business. It all started before that last week with Silvergate, Crypto Bank. They also went out of business. Very scary stuff, especially for investors that have that memory of the banking crisis, right? So you had a run on SVB on Thursday, and they just simply could not match the withdrawals. All right. So we'll get into that. I'll show you guys in a little bit about those two incidents. And then on Friday, we have the jobs report, higher than expected job gains, which is good for the economy. It shows that, there's more hiring, but the market still sees a very tight labor market. The Fed obviously doesn't want that. The unemployment rate did come up a little bit, and the average hourly earnings came down a little bit. So that is something that the Fed wants to see. So it was a mixed report. So anyway, this week, what we're seeing is CPI on Tuesday. Now, this is going to be a very tough week to trade. CPI on Tuesday. We have retail sales and PPI on Wednesday. Thursday, jobless claims, right? A couple of housing and manufacturing data there. Same thing for Friday. So this week is going to be extremely difficult. There's going to be a ton of volume. With a ton of volume, there's going to be a ton of algorithms trading. So just keep that in mind. Do the best you can, manage your risk. All right, so that's the economic calendar. So we saw bond yields go down a lot. We saw a lot of run on bonds. All right, we did see a very nice rally in the bond market, made yields come on down a lot. Like I said, a lot of that had to do with the banking issues that we saw, right? So almost like a flight to safety a little bit here in the bond market. We can see very clearly that huge drop. Now, normally the stock market, the equity market, would go up when we have this much as far as the yields dropping. That has not happened. The market is starting to, I think, realize that the Fed is playing catch up, right? They obviously kept rates way too low for way too long. They're playing catch up. They had to raise rates so high, so fast, and that's breaking things. Okay? That's normal. It's going to break things. And we're seeing some of those banks get broken. We're seeing all that extreme exuberance in the market, those stocks that made no money starting to crash, Bitcoin coming down, meme stocks non-existent. Now that's all what the Fed wants, but they don't want to break things to the point where there's actually runs on banks. And that's what we saw with SVB. There was a big run on customers to get those deposits back out, to withdraw funds. And that's what caused SVB to really go out of business. So anyway, you can see here the yields down big, a big rally in the bond market. Now, if we look at SVB, what happened here? All right. Well, it all starts before that with Silvergate. Silvergate Bank. This is one of those banks that was, not a traditional bank. This was way more of a bank for, crypto, that type of thing. So what happened to Silvergate Bank? Okay, right here. The leading bank for innovative business in fintech and cryptocurrency. Well, they announced it will be shutting down the bank. The market for these types of things, crypto, right? It was at what, 60 something thousand, just ridiculous valuations on a lot of these things. While they did great in 2020, 2021, 2022, once the Fed started to act, these were no longer a good investment. All right. So anyway, the bank is liquidating, plans to repay all of its deposits. All right. So that's where it started about a week and a half ago with Silvergate. And then a bank that it's not so much crypto, but it is dealing with innovative startup tech. Okay. So when Silvergate went out, what happened with SVB? When they came out with news late Wednesday, when it surprised its investors that it needed to raise $2.25 billion to shore up its balance sheet, well, those customers were thinking to themselves, shore up the balance sheet? Well, they must have gotten over leveraged somewhere. They may not be able to continue, doing business as usual. And there was a bank run, okay? People raced to get their money out in one day. In a 24-hour period, customers withdrew a staggering $42 billion of deposits. That is crazy. So some customers remained in it. They didn't take their money out in time. They didn't get to. So now they don't know when they'll be able to get that money back, if they ever will be able to. So a run on a bank can really cause what wasn't a huge, it was an issue, but it wasn't an issue that couldn't be handled. But once you get that run on a bank, then what happened was SVB, to get those withdrawals paid out, they had to sell their bonds, okay? They had bonds that would be fine. If you hold a bond to maturity, you get all that interest and your principal back. But if you have to sell a bond before maturity, which is what they had to do, well, that's going to cause a huge issue on the books for this company. All right. So right here, it said it had been forced to sell all of its available for sale bonds at a $1.8 billion loss, because you can see here, the environment for IPOs, that has not been good with the higher rates. So the Fed broke this bank. That's basically what happened. like I said, when the Fed keeps raising rates like this very quickly, there's going to be things that break. And the first thing is those, right, unprofitable tech startups, which is what this bank deals in. They needed to draw money out to reach payroll, to do whatever, because they simply were not making any money. So once they started to withdraw that money, the bank is now forced to sell bonds that it wouldn't have sold normally. If that didn't happen, they were way over leveraged and they did not do a good job as far as risk management, which we've seen back in the banking crisis. That risk management seems to sneak up on these banks. Now, the big banks, the Citibanks, the Bank of Americas, as far as I'm concerned, they're way more capitalized and have more ways to keep that funds coming in than these types of banks. So I don't think the same thing is going to happen with that, but still it scares people, and that contagion is not good. All right, so we went over all that. Looking back at the sectors on the week, you can see here financial and real estate, they had very rough weeks. The whole market had a very rough week. All three major indexes down over 4%. Not a good week. But what happens is people start to realize real estate, right? Mortgage rates, the housing market, that could come under some really rough times. All right. When people are paying such a high mortgage rate and they're buying at the top of the market and they lose jobs, right? If a recession comes, who's going to pay their mortgage when they lose a job? So anyway, there's some scary stuff going on right now in the economy, especially because this Fed induced, they created the problem and now they're trying to get out of the problem by raising their rates. They're just playing catch up. They really did not do a very good job, in my opinion. So something else we saw was Michael Burry. He had posted something on Twitter. I'll put it up on the screen here for you guys. And when this guy says something, he has been right more often than not. All right. He's the one that called the mortgage bubble. He's the one that called this inflation issue. He's been right and he's made a ton of money. And what he's saying now is the next thing is going to fall here. And he called this WorldCom scandal, which the WorldCom scandal was a major accounting scandal. And this also came into light in 2002 during that tech bubble, during that crazy exuberance in the markets, in the economy. And it just was just a crazy time. And the bubble popped. So he's saying that more fraud, more unveiling of fraudulent situations will start to unravel. Now, just because he says it doesn't mean that, it has to happen, but it is definitely possible in the type of markets we've seen over the last couple of years. Okay, going over to our compass, we're going to take a look at the S&P 500 with the SPY ETF. Now, I'm going to blow your mind again. I know I did it the last couple of weeks. We've had very good calls the last few weeks in these weekly watch list videos. Last week, we had called this, right? So this situation that happened back here last summer, we started to bounce off of that trend line, had some nice green bars, but it was a bull trap. It was a bull trap because we made a higher high here than back here. So a lot of bulls were thinking, you know what? Maybe we do give that 200 another chance and break out. Well, we were warning people that this bounce here at the end of last week, right? That bounce, because we made a higher high, then back here, that bulls were going to start to think, hey, we're going to keep going. I said, watch out for that bull trap. And on Monday, we saw a nice move higher and then a huge flush. All right. We got that trend line. And then we saw Tuesday, Wednesday, Thursday, Friday continue to sell off. We broke that major trend line. Very well called, very good call here on that bull trap. Now, what is really crazy too, you can't forget, we cannot overlook the amount of volume that took place on Friday. That is a massive amount of volume. All right. When you start to see moves like this on very high volume, that's not good. It's not good for the bulls. So anyway, we are approaching oversold areas here on the RSI. So I do expect to get a bounce at some point. I don't know if it's going to happen this week. It's definitely possible. You have this area here that I would be interested in. Now, what we have done on the SPY, on the S&P 500, we opened the year right here. We hit that exact area where we opened the year and we bounced a tiny bit. All right. So we gave back basically the entire year from where we opened on January 3rd. All right. That's what we've seen right here. Retraced the entire move. That is a bear market rally. Okay. In a bear market, you're going to see rallies like this, but that's where we're at right now. If we look at it on the weekly chart, that candle is disgusting, coming off of a bullish hammer candle the week before. This is why we were saying, don't get caught. This could be a bull trap. Same thing we saw right here. This is that area I was talking about. We had a nice candle up and then saw 3 weeks, really 5 weeks of a lot of weakness. But we did see some bounces along the way, right? So you can see that. You can start to see that we could enter that type of market where things look really weak and then you get some bounces because, like I said, that RSI, it is coming on down. All right, now let's look at the Qs. We are under the moving averages. So something that I want to show you guys, what we saw back here is that death cross, right? So that's when the 50 breaks under the 200. What we're seeing back here now currently is that 50 is trying to break above the 200, which would be a golden cross, okay? That would be a positive thing for the market, saying that, okay, it looks like we're starting to settle down here now. The bad stuff has already happened, but there's something that I need to warn you guys about, and it's very similar. I know I bring this up a lot. It's very similar to what happened back in 2001, 2002, during that tech bubble, that extreme exuberance, the same thing that we witnessed the last couple of years. All right. So now back in the 90s, the tech market just went straight from the bottom left of the chart to the top right, culminating with this massive move, massive, from 1998 all the way into 2000, and then had an epic drop, right? The balloon popped. And now what I'm seeing is a very similar setup here. We're going to look at this from peak to trough. The NASDAQ market dropped just about 73%. 73% drop from peak to trough. What I'm noticing is this section right here with the 50 and the 200, okay? That, keep in mind, that 50 and the 200, very similar October bounce, right? So look at this, the year 2001, kind of like 2022. We saw that October bounce. We got a nice move out in January, had a rough February, had a bounce in March, right? Just lasted a couple of days, but then we started to go back on down and we did retest those October lows, all right? That 50 moving average was coming close and it actually broke over the 200 and then broke back under the 200. So if we look at this currently, this is where we stand currently. You had that bounce, nice move up in January, pulled on back in February, started the bounce in March, the 50 getting close to the 200. If the 50 breaks that 200 just a little bit or just touches it, these things are very, very similar. Very similar. I like to look back at patterns. They don't have to repeat. I get that, but they often do. All right. So you're seeing that right here. Back in 2002. And then we saw a really big move on down. All right. And then in 2003, we saw the market finally start to, move on up. And what's crazy about this is from when the bubble burst, right? From the top, it was at 5,000. Well, how long did it take to get back to 5,000? 2015. 2015. All right? That's crazy. So what can happen now? We peaked out at 16,000, which is just a crazy move up from where we were. Very similar amount of percent too since the dot-com bubble, that quick move up. But when do we get back to 1,600? In 13 years? It's possible. It really is possible. So anyway, I don't want to be too negative on this, but I do see, especially in this higher rate type of situation where they're raising quickly, there's no longer free money. Like, it was just so easy monetary policy for so long, way too long. And then we're starting to see the effects of that. So I can see the NASDAQ, definitely coming on down just based on patterns, based on that same type of just extreme exuberance, those meme stocks, crypto, NFTs, all that stuff. And now we're seeing that pullback. All right. So that's the NASDAQ. Going over to the Dow, take a look at this. Just big sell-off. We saw this once it broke the trend line, came back up to previous support, acted as resistance, and then just saw a bad week, right? We saw a bad week, high volume, IWM. This one I had totally wrong, and this was not expected because a lot of regional banks, a lot of small caps are in the Russell. So this had a huge breakdown. What I was saying here is this one looked to me like it was holding up the best out of all the major indexes. Those, very profitable companies that make up these small caps, great PEs, very good value stocks got crushed. And a lot of that was because of the financial sector. All right, so that's the IWM. The XLF, this is the financial ETF. I mean, you can see here, look at the volume. But look where we are on the RSI, right? So what we know is things don't just go straight down forever. There's going to be bounces, especially when you have an RSI that low. I mean, most of these ETFs are showing an RSI that's way oversold. So keep in mind that can produce definitely a bounce when you do start to get that. XBI, the biotech, I mean, look at this, huge moves. So a lot of these are testing those oversold RSI levels. The SPY currently is getting down there. But like we saw back here, which this was a very similar situation that I think is developing right now. We did see the RSI get into this area for a couple of weeks, all right? For a couple of weeks of really rough trading before digging its way out. So while we are going down, while we are getting to that oversold, it can last a couple of weeks before we pull ourselves back out. And like I said, that was a very big amount of volume. So I would be very cautious going forward. Hope you guys enjoyed the video. Hit the thumbs up. I'll see you back on the next one. Take care.